So let's do that. May 2016, question 2B. I guess I'd already shared that question where I was up yesterday, so that those without that first paper, they can print in advance.
30 million ordinary shares in S Limited on 1st April 2018. So S Limited, the ordinary shares I can raise. So 30 divided by 5.
So, and we are told that the following statement of financial position related to H Limited, its subsidiary S Limited, and a subsidiary W Limited. So you already know the group structure, that's a vertical structure. H Limited, its subsidiary S Limited, and subsidiary W Limited. So therefore, it's a vertical structure. So you're given those companies, W, HSW. Then let's go to the additional information. Number one, H Limited acquired 30 million ordinary share in S. H acquired 30 million ordinary share in S. Let's go to the ordinary shares. Let's go to the balance sheet. In the financial statement of S, how many ordinary shares they had? How many ordinary shares they had? Not 500, 50. Are you together? Then of the 50, we acquired 30 million divided by 50. We acquired the ownership through the shares. So which proportion is that? Is it 60%? 60%. Yeah, H Limited acquired 30 million ordinary share in S Limited on 1st April 2008, several years ago, when the balance of the retained profit in S Limited was 800 million and the revaluation reserve was 260 million. Number two, S Limited acquired, so in this case, it's S now acquiring W. S Limited acquired 30 million ordinary share in W. Also, S acquired 30 million share in W. Let's go to the financial statement of W. Ordinary share capital, they had how many shares? 50. Still is what? 60%. When we are doing group, we are doing consolidation, there is something I said very important. Now, how does H control W? H controls W indirectly through S, and H will control W 60% of 60%. And you get what? 36. Who is W? Is that subsidiary or associate? Very wrong. You forgot. There is something I took time to explain here. And I said something very important. If you are unable to interpret this, if you interpret it as a subsidiary, you're sorry, because for everything that you'll be doing will be very wrong. We say that if H can control S and S can control W, you see in this case, S can control W because they are controlling more than a half. Therefore, the parent still can control W indirectly. Are you together? Did I mention something like that? But you forgot. In group, just a small mess. And if you are wrong in the group structure, just the structure itself, everything will be wrong. Even I'll not mark that question. I just cancel that question. Failure to interpret. Because if you interpret it as an associate, that means you're only consolidating H and S. So the only marks I can give you for free is only ordinary share capital and share premium, because you only know that you take for the parent. Sasa. Yes. So even, can you read the question again? B. The following statement of financial position related to H Limited, its subsidiary S Limited, and subsidiary Limited. You are never told an associate, it's a subsidiary. Good. If the subsidiary can control the subsidiary, also the parent can control it. So it's only that if direct control, it's only that 6%. Good. Therefore, the non-controlling interest. Therefore, the NCI is how much? 60? 64. H controls S 60%. Therefore, the non-controlling interest in is how much? 40%. Yeah, in a group, the most important thing is to identify the group structure. Once we're able to identify the group structure, that's the starting point. Good. Number two, I told that S Limited acquired 30 million shares on W Limited on 30th September 2014. 30th September 2014. And when does the year end? 31st? Just look at the question on the required. 31st March 20? 2015. So it has been a subsidiary for how long? Yes, engage your fingers. How many months? There is nothing to think there. It's only engaging your fingers. How many months? 6 months. Eh? I have counted from. So it's October, November, December, January, February, and yeah, that means W has been a subsidiary for only 6 months. 6 months, good. Then you're told that the group, sorry, now let's continue that. S Limited acquired 30 million shares in W Limited on 30th September 2014. On this date, the fair value of some items of plant was 60 million in excess of the book value. You see, that's what we call the evaluation. Yeah, we had evaluation in W. We had the evaluation of 60. Yeah, an item of plant was 60 million in excess of the book value. In addition, W Limited had some patent which had a fair value of 10 million, but were not shown in the books. Also, there is a patent. This was in addition to plant, and also there is a what? Patent, an amount of 10. That means when they are determining their net asset, they never captured 70. Are you together? Because if you omit the patent, which is an asset, that means your non-current assets are understated. So you have to add back. So you have a total evaluation of 70 from its asset that were never captured. So that means you have to add your net asset by 70. Then you are told that the group charges depreciation of 10% per annum on the proportionate basis of plant and an amortization of 20% per annum on the intangible. So let's determine the depreciation. So of this 16, they were supposed to add amortization of this patent, and we are told that, and amortization of 20% per annum on the intangible. So you take 20%, they never recorded the patent of 10, you get the amortization per annum, but have been a subsidiary for only 6 months, 6/12. So what do you get? Is that one? Yes. So you take it back to the income statement and you add them to the cost of sales. Good. Let's go to number 3. Number 3. Between 30th September 2014 and that 1st March 2015, W Limited, W is the subsidiary. W Limited, sales to H Limited and S Limited amounted to 40 and 160. Number 3, that's what we call intergroup what? Yeah, intergroup sales. And in this case, is W selling to both H and also W sold to S. And the good amounted to 40 and 160. Those are what we call the intergroup sales. And we say that for the intergroup sales, you deduct them, you eliminate them in full from both sales and cost of sales. Good. Respectively. Reporting a profit of 25% on selling price. So we want to determine the unrealized profit. And in this case, we are told that reporting up 25% on selling price. Is it margin or markup? Good. That's margin because that is on selling price. So you just take 25% of the intergroup sales. This was 240. This was 160. Then you are told that half of the goods were still in the closing inventory as at that 1st March 2015. Half of them. So a half. So give me the unrealized profit. 120, 60. Is it 30? Then we have 80, 40. 40 divided by 2, you get 20. So the total unrealized profit is how much? 50. How do you account for this 50? For unrealized profit, you add it to cost of sales. You eliminate from the closing stock. And also the intergroup sales, we had 240 plus 160. The total is how much? Is that 400? Yeah, 400. You eliminate it in full from both sales and the cost of sales. Good. Let's go to number 4. Number 4, you're told that H Limited and S Limited owed V. That's what we call what? Intergroup balances. So we are told that H Limited and S Limited owed W, shillings 36 million and that 2 million respectively as at the end of the year. So 36 plus that 2, and you get 68. How do you account for intergroup balances? We say that you eliminate them in full from both account receivable and account payables. Good. Number 5. The profit after tax of W Limited for the year ended that 1st March 2015 amounted to 40 million. And it's assumed to accrue evenly throughout the year. So that's the profit that W made during the year. They made a profit of how much? 240, but it has been a subsidiary for how long? 6 months. Good. So that one will help you to determine the pre-acquisition retained earnings, which will enable you to determine the goodwill. Good. No dividend were paid by W Limited during the year. Number 6, the goodwill of H Limited and S Limited is fully impaired. So before we talk about the impairment, we have to compute the goodwill. But we say that you don't focus more on goodwill. So how do you determine the goodwill on the investee? So in this case, the parent is H. So we compute the goodwill in S and W. S, W, and how do you get the goodwill? You take the purchase consideration, and we say that to get the purchase consideration, you go to the non-current assets. Let's go to the non-current assets. Let's go to the non-current assets. And the non-current assets, we have investment in S. How much was investment in S? We more than 840. What about investment in W? But W was acquired by who? By S. Are you together? 750. So how much is the purchase consideration? Can you compute that and give me the answer? Give me the purchase consideration. They don't remember. 450. Yes. Now, if S paid W 750, we assume that the parent contributed 60%. Are you together? So 60% of 750 you get? Good. I have students who are revising. Then you less net assets acquired. And you see that how do you get the net asset acquired? We go to the equity aspect. Let's go to the equity. Let's go to the equity. So kindly don't make sure you're not copying. To the ordinary share, to the equity, we have ordinary share capital. How much is the ordinary share capital in S? 500. Then we have revaluation reserve. And we say that for all revaluation reserve, or all the reserves, you take the pre-acquisition. Are you together? So in this case, the only one we have is 260. Can we go to note number 1? Let's go to number 1. H Limited acquired that million ordinary share in S on 1st April 2008, when the balance of the retained profit in S was 800 and the revaluation reserve was 260. So revaluation reserve was 260. What about in W? We have a dash, right? But we have a 70. Now let's be here. Remember at the date of acquisition, when we are acquiring W Limited, we have some plant which had a revaluation of 60, and also we have the patent which was omitted. So that one increased the value of the net asset. Are you together? So we have a total of how much? 70. Then what else do we have to the equity? We have retained profit. And you see that for retained profit, you take the pre-acquisition. Let's go back to note number 1. In S Limited, at the date of acquisition, how much was the retained profit? Yeah, it was 800. What about in W Limited? Let's go to the equity. Let's go to the equity. Retained profit of S is how much? 680. So now let's be here. The retained earning at the end of the year is 680, but we acquired them 6 months to the end of the year. So we need to determine how much was the profit at the date of acquisition. But in note number 5, The profit after tax of W Limited for the year ended that 1st March 2015 amounted to 40 million, and it's assumed to accrue evenly. So during the entire financial year, they made a profit of 200. So that means for the first 6 months, they made a profit of 120. They made a profit of. Now, can you be able to determine the retained earning at this date? You just take 680. You eliminate the profit for the 6 months. So how much was the pre-acquisition retained earnings? 500. Yeah, 560. So the pre-acquisition retained earning in W was 560. So I've taken 680 minus 120. To the equity, do you have anything else? No, didn't have anything else. So give me the net asset. 13, 14, 15. You have 15, 16. But of the 15, 16, we are controlling a 60%. 60%. Yeah, take 60% of 156. 930? 936. Give me the difference. That's what we call the goodwill. You have a negative goodwill. Eh? That's what you call a capital reserve. 96. 96. But a negative. Now let's go to W Limited. The total is how much? 1130. You multiply by 36, correct. The parent, remember in this case, is the parent who is H will report the goodwill. And if H controls W, 36%. Yeah. 36% of that is how much? Sorry? 406.8. Therefore, how much will be the value of the goodwill? 43.2. Good. Now we can go back to note number 6. Note number 6. In note number 6, we are told that the goodwill of H Limited in S Limited, H in S, was fully impaired. So this is fully impaired. Then, while that of S in W Limited is considered to be 10% impaired. So let's deduct the impairment. So 10% of this is 4.32. How much will be the net goodwill? 38.88. And this is what now you'll take to the balance sheet. And then this impairment, you take it to the income statement as an expense. Good. The group uses partial goodwill method for accounting. Required. The group statement of financial position. They even don't require the balance sheet, the income statement. They want the balance sheet. So you can take a screenshot of that. Yeah, I'll not give you time to copy so that we can do as many questions as possible. Good. So now let's present the balance sheet. So let me just grab this. So intergroup balances was 68. Just note that. And the goodwill is that 8.88. That's the only item we need the balance sheet. Now, who will consolidate the financial statement? H. So it will be H. Yeah. H group. Consolidated statement of financial position. As at that 1st March 2015. So let's start with the assets. Non-current assets. So under the non-current assets, what do you have? Number one, we have PP. And for PP, we have subsidiary and sub-subsidiary. We consolidate everything. 1280, you add 920, you add 700, then you add 60. Remember, there was a revaluation of plant, but later depreciated by how much? Depreciation, 10% of that was 3. Good. Then we have investment in S, investment in W. We see that investment in S, investment in W replaced by what? Goodwill. Those are investment. And how much was the goodwill? 8.88. Then we also had the patent that they never recorded. How much was the value of the patent? 10, but later it was amortized by 1. So you have 9. So give me the value of PP. Sorry? 2957. Good. Then let's go to the current assets. Under the current assets, we have inventories. Inventories, we have 420. You add 410. And then you add 210. What do we eliminate? We eliminate the unrealized profit. And we say how much of the unrealized profit? Unrealized profit of 50. Sorry? The total is how much? 990. Good. Then we have trade receivables. Trade receivables. For the trade receivables, we had an amount of 680. You add 540. You add 390. Then you eliminate the intergroup balances. How much is the value of the intergroup balances? 68. Good. What do you get? 1840. 15. 1542. And lastly, we have the bank balance. The bank balance, we had 80 plus 90 plus 100. And that's 200 and 270. Then we go to equity and liabilities. Under the equity and liabilities, we have ordinary share capital. How much of the ordinary share capital? Yeah, good. We see that you only take for the parent. For ordinary share capital and the share premium, we don't consolidate. Then we also have revaluation reserve. How much is the revaluation reserve? 0. Remember, we said that our reserves you take for the parent and then you add post-acquisition changes of the investee. Are you together? Now, the 260 we have, can we go back where we have revaluation reserve of S? That was the pre-acquisition. And that's what you are told in note number 1. Can you go to note number 1? H Limited acquired 30 million ordinary shares of S on 1st April 2008 when the balances of retained profit in S Limited was 800 and the revaluation reserve was 260. And that's what you are given in S Limited. Are you together? But now assuming that the parent had a revaluation reserve, let's assume 50. And then in this case, the revaluation in S Limited, assume it's 300. So we have said that for the revaluation reserve you take for the parent, then you add the post-acquisition changes in the net asset of the investee. So we could have taken this. We are controlling S Limited 60%. You could have taken 60% of the post-acquisition changes. You just take the 300, and at the date of acquisition, the revaluation reserve was 200. So there was a change of how much? Of that 40, you take 60%. That's how we report that. But in this case, you don't have that. Then we have retained profits. Retained profit. We see that retained profit never compute. Are you together? Let's go also to NCA. Also, NCA says that you don't compute, but NCA sometimes it's very easy to compute. Now let's go to the current liabilities. Under the current liabilities, we have trade payables. How much is the value of the trade payable you take? 390, you add 380, you add 210, you deduct who? Yeah, you deduct 68, the intergroup balance is 68. You get? 912. Then we have the current tax. And the value of the current tax, it's 40 plus 20 plus 10, and you get 70. Let me show you how to get NCI. And compute NCI. NCI. And in this case, we have two subsidiaries. We have S, we have W. We compute the one in S, the one in W. So we are controlling S, we are controlling them 60. Therefore, NCI is how much? It's 40% of the net asset. Let's go to the net asset. Let's go to the equity. Equity ordinary share capital of S is how much? 500 plus revaluation reserve of 260 plus retained earnings of 1550. Then you add 70. Are you together? Now let's be here. In S, was S or who revalued the items? Was it W or S? It was W, so it's not S. Good, that's okay. Give me that. You take 500 plus 260 plus 1550, then you take 40% of that. Sorry? 924. Now let's go to W. W, the parent controls them 36%. Therefore, the answer is how much? So it will take 64%. Let's go to the equity. Let's go to the equity. They are worth, they have ordinary share worth 500. Then they have retained profit of 680. Then there was a revaluation of how much? 70. But of this 680, this being the retained profit, you need to adjust the retained profit. How? Number one, they never deducted the depreciation and amortization. Remember, they revalued the item by 60 and 10. So they were supposed to deduct a depreciation of 3, an amortization of 1. So minus 3 minus 1. Then let me take you back to note number 3. Let's be here. There was intergroup sales. Who sold to who? W sold to? Also W sold to? That means they made a profit. And that profit is already included in the retained. We eliminate because the intergroup balances. Retained unrealized profit of 30 and 20. The total is how much? 50. You eliminate it from there. 50. Give me that. You have already taken 64%. You get 0.44. Then you raise investment in W. Now, when you're computing the goodwill, can you go to the purchase consideration? Or let's go to the non-current assets. Non-current assets. Can you see investment in W? How much was it? Investment in W? 750. When you're computing the goodwill, we never took 750 as the purchase consideration, right? We took 60% of 750. Are you together? Therefore, there means there is a part not controlled by the parent. Yangapi? 40%. That's why I told you mnaachana NCI na retained earnings. Sasa, good. Mnapata ngapi? 300. Now give me the value of NCI. $13? 1389 point? Yes. So under NCI, we had 1389.44. Now, can you add the total assets? Add the total assets. Add the total assets. So this was revaluation. This was depreciation. This was unrealized profit. How much is the total assets? $58. 06.88. Can you add the total equity and liabilities? Therefore, can you take 58 minus the answer? 28, that 5.44. Now, has it balanced now? Yeah, you can add the equity. That's how balance the retained earnings, that 806 point. So we can take a screenshot of that. Good. Let's try another question. Can try another question. May 2016. May 2016, question 1. So we are told that on 1st April 2015, D Limited acquired 80% of the ordinary share in S. D acquired 80% in S. Therefore, that means S is a who? It's a subsidiary. S Limited had acquired 60% of the ordinary share in E Limited on 1st July 2010. S had acquired E 60%. Now, my question is, how does D control E? How does D control E? 80% of 60%, which is 42. Who is E? 48. Who is E? Asset or subsidiary? Yes, now you know, it's a subsidiary. Yeah, if the subsidiary can be able to control the subsidiary, that means also the parent can control it. Are you together? Yes. But if you have D controlling S 52%, then S controls E 50%. Who is S today? The subsidiary. Who is E to S? It's a? Yeah, it's an associate or joint venture. Are you together? Yeah, it qualifies to be a subsidiary if it's more than 50%. 50%. So therefore, if S cannot control E, even D cannot control who? E. Are you together? Yes. Then you are told that D Limited, that's the parent, had also invested in the ordinary share of A to an extent of 75% on 1st April 2012. D has also invested in shares of A, to a magnitude of 75%. Who is A today? The subsidiary. Good. Yeah, I told you for group, first of all, interpret the group structure. Once you're able to interpret the group structure, it will be good. So D Limited has also invested in shares of A Limited to an extent of 75% on 1st April 2012. On 30th June 2015, D Limited disposed a third of its investment in A Limited. On 30th June, D disposed a third of its proportion in A. So a third of 75% is how much? There was disposal. A third of its 75%, Ningapi? 25. So we are controlling it 75%. We disposed of that 25%. And the proportion remaining is how much? 50%. So that means the status of A changes to an associate. Are you together? Yes. So now D has ceased now to become an associate. So that means now we'll be accounting for A at the end of the financial year using the equity method. Are you together? Yes, we cannot control it, but now we can only exercise a significant what? Influence. Good. The following financial statement relate to the above companies for the year ended that 1st March 2016. Can you underline that 1st March 2016? Now let me take you back. When did you dispose A? When did you dispose A? Yes, I know it's 2015. That year? June. But the year ends on that 1st March 20? How many months to the end of the year? How many months? 9 or 6? Good, 9 months. So now let's be here. That's the financial year. That means this is where we made a disposal. So that means A was a subsidiary for how long? For that financial year? 3 months. Good. Then it became, we disposed them 9 months to the end of the year. So for the remaining 9 months, it becomes our own. An associate. Good. So that means if you're preparing the income statement, A will be consolidated in the income statement. Are you together? But the balance sheet, remember the balance sheet is at the end of the year. At the end of the year, we don't consolidate it. We account for it using the equity method. Remember, we don't consolidate associate. So the following financial statement relate to the above companies for the year ended that 1st March 2016. So we have the statement of comprehensive income for the year ended that 1st March 2016. We have that. Then we have the statement of financial position. Let's go to the additional information. Number 1, D Limited acquired its investment in S Limited and A Limited when the revenue balances of S and A were 2,600 and 650 million respectively. So that's the goodwill on acquisition of S and A. Do you have to compute goodwill? Matuachane nayo. To compute. Yeah. Goodwill on acquisition. And you see that you only consolidate the goodwill of subsidiaries. For investing, for associate, you don't. That one you take it, you account for it for investment using the equity method. So in this case, we compute the goodwill for S and E. S and E. Also, you can we can also determine for it, because number 1, to determine the gain or loss on disposal, we'll have also to determine the unimpaired goodwill. Yes, also for A. We take the purchase consideration. So how do we get the purchase consideration? Go to the non-current assets. But the non-current assets, we have investment in S. How much was investment in S? 67, 20. Investment in E, 4,600. But E was acquired by who? S. Are we together? So it's 4,600. But remember, E was acquired by who? S at 4,600. But the parent was controlling S 80%. So you take 80% of 4,600. Sorry? 3680. Then we have in A, investment in A. We acquired them for how much? 44, but that one was acquired by the parent. So you take the full purchase consideration, 4480. Then you raise net assets acquired. For the net asset acquired, let's go to the equity. Go to the equity. We had ordinary share capital. Ordinary share capital. In S, that's 200. E, 2,000. A, 2,500. Then they had the share premium. The value of the share premium we had 1,600, 1,000, and 1,250. Then you have revenue reserve. That's the retained earnings. But you see that for the retained earning, you take pre-acquisition retained earnings. Let's go to note number 1. D Limited acquired its investment in S and A Limited when the revenue reserve balances of S and A were 2,600 and 650. This was 2,600 and the other one was 600, and you're not told about A. We'll come back to that. Number 2. The revenue reserve of E amounted to 24 million as at 1st July 2010 and 2270 million on 1st April 2011. Can we go together pre-acquisition retained earnings? Sorry? There is 650. 650 is for A. Let's read number 1 again. D Limited acquired investment in S. Oh, it's S and A. Yeah, so it's 26. This one should be 650. Good. Number 2. The revenue reserve of E, good, amounted to 24 million as at 1st July 2010 and 27 as at 1st April 20. What does it mean? The revenue reserve of E. Now, when did we acquire the E? When did we acquire? Let's go back. We acquired 60% of the share in E on 1st July 2010. Now let's go to note number 2. The revenue reserve of E Limited amounted to 24 on 1st July 20. To sharp retained earnings. Yes, that's the retained earning at the date of acquisition. How much was it? 2,400. Good. And 2750 million as at 1st April 2011. So that one has no effect. Then we are told that number 3, during the year ended that 1st March 2016, S Limited sold goods. So number 3, it's all about intergroup what? Intergroup sales. It's good for you to know who sold to who. During the year ended that 1st March 2016, S Limited sold good at a normal markup of that 3 and that at a price of 2,400 million to D. S sold to D, goods valued how much? 2,400, and made a markup of that 3 and a third. On the same as a third. How many aje? That 3 one of these is the same as a third. But that was markup. But we are given the sales. So to get the unrealized profit, you convert the markup to itakuwa ngapi? 1/4. Good. You see, it's 1/3. So to convert it to margin, you just take 1, you add it there, and you get 1/, or you can still take 33.33, you divide by 133.33, the same as that. So to get the unrealized profit, you take 1/4, you multiply by 2400, then you multiply by, then you're told that 20% of the goods remained unsold by D Limited as of that 1st March 20. By the end of the year, they have not sold 20%. So the unrealized profit is on the remaining stock. What do you get? 48 divided by 4. One? 120. Good. How do you account for this 120? You add it to cost of eliminate from the closing, but the total intergroup sales you eliminate in full from both sales and cost of sale. Good. Number four. The financial asset held at fair value through profit and loss in the books of D have not been adjusted for their fair values of 1,200 million. Can you go to the current asset? Let's go to the current asset. Financial asset held at fair value, say that they are short term. How much is the value? In the books of D, that's what we are told. And the current assets, we have financial asset through profit and loss. In the books of D is how much? It's 1,000. Are you together? It's 1,000. Now let's go back to root number 4 again. The financial asset held at fair value through profit and loss in the books of D have not been adjusted for their fair value of 1,200. Now fair value is the market value. Are you together? Yes. So that means there is a fair value gain of how much? 200. That one you take it under? It's not under river. That one, I never did it at the date of acquisition. Are you together? It was done during the year, and this financial, it's current assets. We say that for the current asset or items measured, let me take you back to the published. For the item revalued at fair value, their fair value gain should be reported under other income. Are you together? If it was available for sale, now that's what you take to revaluation reserve or under other comprehensive income. That one we just reported to the part of other incomes. Are you together? Yeah. Then revenue reserve of D include the fair value adjustment of available for sale for financial asset. Yeah, the revenue reserve. So that means they also revalued available for sale, of which they already have adjusted. So that one has no problem. Number 5. Investment income includes dividend received from subsidiaries. Yeah, that means it's an intergroup balances. You eliminate. Who do you pay dividend to? Shareholders. Are you together? Of which in this case, D is the parent. So they have some dividend that was received from the investee. So that one you have to eliminate in full because after all, the intergroup balances. Number 5 again. Investment income includes dividend received from subsidiaries. D received that 200 million from S, while S received that 6 million from E. Total dividend paid by D amounted to 2 million. Yeah, the one that was paid to D, that one can only affect the retained earnings, but cannot affect the intergroup investment income. Number 6, the disposal proceeds for the sale of shares in A Limited on 30th June 2015 amounted to 1,500 million received in cash. D Limited will account for the remaining interest in A using the equity method in accordance with IAS 20. Yeah, therefore you have lost the control. Now we can only exercise a significant influence. And we say that whenever we dispose, we can either dispose at a gain or a loss. How do we get gain or loss on disposal? Kalamu inakataa kuandika. So gain or loss on disposal of subsidiary. Who can remember that? Say that you take disposal proceeds, you raise what? The amount of net asset disposed. Also you raise, yeah, the unimpaired goodwill. But you see that not unless it's just required, you can just ignore it. Let's go to number 7. Number 7, you are told that included in the trade receivable and trade payables are the following balances. So that's what you call what? Number 7, intergroup. Yeah, intergroup balances. That one goes to the balance sheet. Due from D to S. D to S, an amount of 250. Due from A to D. Now let's be here. Due from A to D. Remember, the intergroup balances will affect receivable and payable. Are you together? And that goes to the balance sheet. And the balance sheet is prepared at the end of the year. But by the end of the year, A has ceased now to be an, yeah, now it's an associate. Do we consolidate that? No. Good. Then due from E to S. E to S, that is in the group. So E to S, an amount of 240. Therefore, the intergroup balance is an amount of 490. You will made from account receivable as well as account receipt. Yeah, receivable and payables. Good. Number 8. Inventory sold by S to D, worth 60 at a normal markup, had neither been received nor recorded in D as of that 1st March 20. Can you read that question again? Read that point again for you to understand. They tell me on how to adjust on that. How do you adjust on that? Have you understood the question? Now, how do you adjust for that? Inventory sold by S to D was 60 at a normal markup, had neither been received. That's what you call the goods in transit, and had a markup. That means the intergroup from S to D was not supposed to be 24, was supposed to be 24 what? Hamukuelewa swali. Nimesema umeelewa. Kuna kitu umeelewa. You haven't understood the question. You haven't understood the question. Should be 24? Good. You are at 16. If they sold good worth 24.60, that means they only recorded 24. 60 has not yet been received. Therefore, the intergroup balances from S was 24.60. It's only that they only received 24. Therefore, you also need to determine the unrealized profit. Because if they have not been received, that means the profit is already included. Are you together? At a normal markup. So you take 1/4 of 60. How much do you get? 15. So that means for our unrealized profit of 2,400, we had 120 plus the goods in transit. Are you together? Has a profit of how much? 15. So the total unrealized profit will be 135. Good. Then when consolidating the inventory, you also have to add 60 because it has not yet been received. Good. Number 9. All goodwill in the investing company had been impaired by 25% during the year ended that 1st March 2015. No impairment accrued in the year ended that 1st March 2016. So during the year, there was no impairment. The group uses partial goodwill method to prepare the group financial statement. So first of all, let's compute the goodwill. Give me the goodwill. Give me the total of this. $74. Then this controlling S 80%. So 80% of 7,400 is how much? 59.20. So 67.20 minus the answer. 800. Give me the total of this. 3, 4, 5, 6. 6,400, right? 54. 2, 3, 4, 5. Yeah, it's 54. Then you multiply by, how does D control A? 48 per? Take 48%. 25? 2592. So that's 680 minus the answer. You get a goodwill of 1080. 1088. Let's go to A. A, 25 plus that 40. 44. You multiply by, now let's be here. You will multiply by how much? D to A. Yes. Now, in this case, you don't have to cram. Can you now think logically? Yes, it's 4400. You multiply by what? Okay? Very wrong. Now, let me ask you a question. How do we compute goodwill? At the rate of acquisition? We don't compute the goodwill at the date of disposal. Are you together? And when you acquired it, we acquired 75 per. We want to determine how much was the goodwill at the date of acquisition. At the date of acquisition, we are controlling them 75 per. Good. Give me 75% of that. Sorry? 3,300. So how much was the goodwill at the date of acquisition? 1180. Then, now we can read at note number 9. All goodwill of investee company has been impaired by 25% during the year ended that 1st March 2015. So we deduct impairment. 25%. 25% of this is 200, right? You get 600. 25% of that is how much? 272. How much do you get? Eight? 816, eh? Give me the total goodwill. Remember, the goodwill will be presented to the balance sheet. Are we together? You take 600, you add 816, and you get 14. I have not added for A because by the end of the year, A is an associate and you have disposed. Are we together? I'll show you how to use this goodwill. Now let's determine the gain or loss on disposal. You take the disposal proceed. How much is the disposal proceed? Let's go to note number 6. The disposal proceed from the sale of share of A on 30th June 2015 amounted to how much? Yeah, we sold it for 1,500. You raise the net asset disposed. How much was the net asset disposed? The net asset, let's go to the equity. Let's go to the equity. How much was the ordinary share capital? We are disposing A, right? We had 2,500 plus share premium of 1,250 plus revenue reserve of 1,650. But we have to adjust this minus. You see, 1,650 is the retained earnings, eh? But we dispose them 9 months to the end of the year. Now, this is what I mean. This retained earning of 1,650 is at the reporting date. Are you together? But we dispose them 6 months to the end of the year. Can you deduct the profit so that you determine how much was the profit at the date of disposal? Because 1,650 is the retained earning at the end of the year. So let's go to the income statement. Go to the income statement. Go to the income statement. A, they made a profit of how much? Profit for the year? 8? Yeah, during the year, they made a profit of 800. So we eliminate the profit for the last 9 months so that we determine how much was the retained earnings at the date of disposal. So you minus 800 times 9 over 12. Together. So what do you get? Hii mnapata ngapi? 66? 600. Okay, now take 2,500 plus 1,200 at 1,250, 1,650, but this retained earning, you raise the post disposal of 600. You get? 4,800. Then we disposed 25 per? Hatukuuza yote, tuuza 25%. Kwa hivyo value yake ilikuwa ngapi? Of your answer times 25%? Yes? 1,200. Also, you raise an impaired goodwill. You see at the rate of disposal, how much was the goodwill? The goodwill on acquisition of A was 1180, of which has already been impaired by how much? 25%. So 25% of this is how much? $290. So how much was the remaining goodwill? Because there was no goodwill during the year. Are you together? 8. So for an impaired goodwill, you will take 885, you multiply by hatuguza goodwill yote. Sawa sawa. We only disposed 25 per. That's why I told you, I was giving you a disclaimer. Tuachane na goodwill, tuachane na gain or loss on disposal. This is giving you a nightmare, Na mwalimu wako hapa na ukiwa peke yako utaandika nini? You know, if you never completed goodwill on that one, we could have already completed the financial statement. Sawa, fikirieni hiyo mniambie ni ngapi? You're getting how much? Nione kama mnanidanganya. Because I know that one is wrong. You're getting how much? It's 885 minus what? These are the unimpaired goodwill. Are you together? At the date of a disposal, the goodwill unimpaired was 885, but we never disposed everything. We only disposed 25%. 25%. You get how much? You get 220, 221.25. Therefore, how much was the gain or loss on disposal? Gain or loss. That must be a gain, Those are the gain yangapi? 78 point. That one is only giving you 1 mark to the income statement. So I think we are through with all the workings. So can you take a screenshot of that? But kind of you will not have time to compute goodwill or to compute the gain or loss on disposal. Are you together? Yes. So now let's go to the required. Required group statement of comprehensive income and the statement of financial position. Start with the income statement. Who is the parent? So it's D group. Consolidated statement of comprehensive income. For the year ended that 1st March. Where? So let's go to the income statement. So we have revenue, US, cost of sales, and that's how you get your gross profit. So what do you include? 26,400. You add 24,000. You add 20. You add. Do you add for it? We have to add it. 15,000, but good. 3/12. Then to the cost of sales, 12,000. You add 12,000. You add 16,000. Also for the associate, 12,000. But remember, for the first 3 months, it was a subsidiary. You take 3/12. Then to the cost of sales, you add the unrealized profit. How much was the value of unrealized profit? 135. Yes, 120 plus the 15 for the good in transit, right? Then what else? You eliminate in full. Are you together? Intergroup balances, intergroup sales. How much was the intergroup sales? Good. 2460, 2460. What do you get? This one you get 71,690. What about for the cost of sales? That's 71,690 or 960. 690, eh? Good. Let's go to the cost of sales. You take 12, that's 24. 24 plus 16. Then you add 3,000. Then you add 135, 2460. What do you get? 40? 4625, eh? 675. Therefore, how much is your gross profit? That 9? That one? 050. 15, eh? Yes. And that one carries 4 marks. Then from the gross profit, now what else did we have? Can you see investment income? Investment income. How much is the value of investment income? 35, 20. You add 540. You eliminate intergroup balance. Do you have intergroup balances? Yes. Can we go back to the information about the dividend paid? There is something I explained about the dividend paid. That was in note number. Yeah, can you go to note number 5? Note number 5, you are told that investment income include dividend received from subsidiary. So it's an income within the group. Are you together? So you eliminate it in full. So investment income include dividend received from subsidiary. D received that 2 from S. You deduct that 2. Where S received 360 from E. That's what we call the dividend within the group. Total dividend paid by D. D, yeah, hakulipa mtoto hapa sawa sawa. Alilipa to the shareholders. It's not within the group. Within the group. So that one did not factor in. That will only affect the retained earnings. What do you get? Five? Yeah, 500. Eh? Then we had fair value gain. Yangapi? Amukubuki. Can you go to note number 5? Note number 5. Note number 4. The financial asset held at fair value through profit or loss in D had not been adjusted for their fair value of how much? You take 1,200. Let's go to the income balance sheet. Current asset, 1,000. So there was a fair value gain of 200. Yeah, do you see that the fair value gain should be reported under other income? So you show it there because it was for the parent. It was not for the investee. Are you together? Yes. Then from there we go to the expenses. What do you have to the expenses? Also, we had a gain on disposal of subsidiary. Situlitafuta. Yeah, gain on disposal of subsidiary. 70? 78.75. Then let's deduct the expenses. What do we have to the expenses? We have distribution cost. Under the distribution cost, you have 3320, you add 2360, you add 1360, you add 800 times 3/12. Then you also have admin expenses. Yeah, we have that 880, then you add 2440, you add 1140 plus 900, 3/12. Then you also had finance cost. Finance cost was an amount of 420. So how much is the distribution or admin? 76? 7685. 72? 7240. And you get your profit before. Remember, there was impairment of goodwill, but that impairment was not for the current year. I told that there was no impairment for the current year. In case there was impairment for the year, you could have added impairment of good as a separate item, right? Together. Yeah, but we didn't have impairment during the year. So give me the profit before tax. Sorry? $16? 448.75. Once you have the profit before tax, you deduct your tax expense. How much was the tax expense? 24? 2440, you add 2400, you add 580, then you add 500 times 3/12. What do you get? 55? 45. Now give me the profit after tax. 10? 903.7. Yeah, once you have the profit after tax, you add, that's under other comprehensive income, associate share of profit after tax. And we are controlling the associate 50%. Let's go to the income statement. Give me their profit after tax. Is it 800? Yes, that's A. They made a profit of 800, but it have been an associate for how long? Yeah, 9/12. Good. You get 300. 3 or 600? 300. Also, we had revaluation reserve of available for sale. Yeah, that means was for the year revaluation reserve. How much was that? Was it 500? It's for the parent. Are you together? Yes. Now, can you get the difference between available for sale and financial asset at fair value? One goes to the other income, the other one goes to? Yeah, to other comprehensive. And the one goes to the other comprehensive, it goes to the revaluation reserve. Valuation reserve. And that's how you get the total profit. Total profit. Once you get the total profit, you can show attributable to, but not a must. Attributable to parent, and then CI. Let's go to balance sheet. That was requirement number 2. That's D Limited or D Group. Consolidated statement of financial position as at 31st March 2016. What do you have to the balance sheet? PPE, right? How much is the value of the PPE? Yeah, assets, non-current assets, we have PPE. To the PPE we have 8760, you add 2200, you add 4500, you add. Oh, remember the balance sheet at the end of the year, we don't consolidate the associate. Are you together? Yes. Hata usichukue 3 months of a 12, nothing. By the end of the, you see, when you're presenting this one as that first March, it has already ceased to be an associate. Are you together? Yes, you only consolidate the subsidiary. Haitaingia mahali. To the income statement, it's only, it was for the year. Are you together? We had to factor in the 3 months. Or you get 15? 460. What else do we have? We have available for sale, an amount of 3,000. Then we have goodwill. How much is the value of the goodwill? Angalia kwa screenshot for the two, 14 was 1416, 1416. What else? Then you're supposed to show investment in associate using the equity method, but we never computed that, and I'm not showing how to compute that. Let's go to the current assets. What do you have to the current assets? Inventories. For the inventories we had 2100, you add 2200, you add 1650, you add 60. We had good in transit. Are you together? That means was not captured. Are you together? Tuziongeze, then to unrealized profit. How much was the unrealized profit? 135, including the unrealized profit in this 60. If it is in transit, that means in the books of A was never recorded. So you have to record them because that they are good. What do you get? 68? 587? 5. What else do we have? Trade receivables. Trade receivables. The trade receivables, what do you have? 2640, you add 6600, you add 500, then you rest intergroup balances. How much was the intergroup balances? Just confirm. We had 250 and 240. That was for now? Or 90. Good. What do you get? 90? 92.50. Then we have financial asset at fair value. Yangapi? Good, 1200. You don't show the 1,000, There was a fair value gain of 200. Therefore, you're supposed to show it at its fair value, 1200. Then we have cash and cash equivalents. To the cash and cash equivalent, we have 400. You add 2200. You add 300. An amount of 29. But you're also supposed to add the cash in the cash on disposal of proceed, disposal of subsidiary. To lose a pesa ngapi? Let me not complicate it for you. Let's go to the equity and liability. Equity and liabilities. You have 2 free marks there. Which one and which one? Ordinary share capital and? Yeah, ordinary share capital and the share premium. How much is the ordinary share capital? Yeah, you only take for the parent, and the share premium we had 3,000. Then we have revenue reserve. What is revenue reserve? Revenue reserve is the same as retained earnings. Sasa. Yes, hiyo tutatafuta kweli? Hapana. Also kuna ends ya tafuta ama tuachane nayo? Tuachane nayo. Let's go to the non-current. But we have available for sale reserves. Hiyo ni rahisi sana. Available for sale evaluation. Yangapi? Now let's be here. To the other comprehensive income, we had a revaluation reserve of available for sale of fiber. Yeah, and it was for the parent, so you're not taking any provision. That's a free mark. Let's go to the non-current liability. What do you have to the non-current liability? We have 12% loan stock. How much is it? Just work with the free marks. Eh? Then we have deferred tax. You just consolidate. We had how much? 2660. You had 2200. You had 370, and you get amount 5230. Then we go to the current liability. To the current liability, we have trade and other payables. The trade payables, we have 20. Then you add 3000. Then you add 790. Then you deduct who? 490, the intergroup balances. 53? 5328, eh? 2020? 20, eh? And lastly, we have income tax. That's the current tax. Eh? Current tax we have 2340. You add 2200. You add 670, and you get 5210. And therefore, don't bother even to balance. Eh? Do you have at least 5 correct? You could have gotten correctly. Which one? The first one. But if you are unable to interpret the group structure, you get nothing. Are you together? Group structure is very important. You can get that available for sale, goodwill, inventory. That one you can get, but in this case you could have not gotten. Eh? Let's not count that. Eh? Receivable is very easy, very easy, very easy. Ordinary share capital, share premium. Available for sale you can get, but you'll forget, right? So let's not count that. Then loan stock, actually to the current liability, you get everything. Eh? As simple as that. Don't complicate yourself by computing goodwill. Now unajua kabisa, your capacity cannot allow you to get it correctly. Eh? Yeah, actually, if you get a paper, if there is a question, I usually tell students to do it as the first question in a group. Believe you or not, if there is a question for students who work smart, they usually score everything. It's on group. If you know how to determine the intergroup balances, intergroup sales, and realized profit, that's a goodwill. Are you together? Yeah, group umepita. It's the easiest hata kuliko ya share based, eh? Na segment. Do it as the first question. You can take a screenshot of that. Then we take a 2-minute break. We can do one for foreign branches, not foreign branches, eh? Foreign subsidiary. Eh? Break of 1 minute, not 2 minutes. What's here? November 2016. Question 1. H Limited, a public limited company based in Kenya, owns 75% of the ownership share capital of S. Therefore, NCI is 25%. A public limited company based in Rwanda. H Limited acquired S on 1st May 2015. Can you understand that? 1st May 2015 for 1,200 million Rwandan franc. When retained profit of S Limited were 800 million Rwandese franc. The functional currency of H Limited is Kenyan shillings. The functional currency of S Limited is the Rwandan franc. S Limited has not divided its asset or issued any share capital since its acquisition by H Limited. The following financial statement related to H Limited and S Limited. Statement of financial position as at 30th April 2016. So can you underline that? 30th April 2016. When did we acquire S? And the year ends on 30th April 2016. So that means S has been a subsidiary for how long? 1 year. Good. Then there is something we said in foreign subsidiary. We said that when determining the goodwill, always determine the goodwill using the foreign currency, and then you'll be translating it at the end of each financial year, because we say that. Now, in this case, which method we use to translate? I gave you two methods. We had the temporal method, and you have the closing rate method. closing rate. Tulisema temporal is for dependent subsidiary, wholly owned. Are you together? This one is an independent. Why? It's not wholly owned. We only control 75%. So in this case, we use the closing rate method. Therefore, we say that under closing rate method, remember that I gave you the mode of translation. Right together. You see that all asset liability should be translated using? Don't remember. Income statement item should be translated using? Average rate. Good. Then equity item should be translated using? Spot rate. Good. All assets and liability should be translated using? Yes. When using the closing rate method, income statement items, we use the average rate. Then all assets and liabilities, we use the closing rate. Then equity items, you translate using the spot rate. Then we say that when you're using the temporal method, I say that the temporal method is applied in addition to dependent subsidiary or income statement item, we still be translated using the average rate. But for monetary items is the one use the closing rate. And we say that the monetary item include cash, receivables, and all liabilities. Then for non-monetary items, you translate using spot rate. Non-monetary include other items that are not monetary. Just know that monetary we have cash, receivable, and all liability. So that means all non-current assets, all the equity, they are part of non-monetary items. So I was saying that we say that when determining the goodwill, we compute the goodwill on a foreign currency. So that you see, we are saying that for the asset liability be translating using the closing rate. The rate at the end of each year keeps on changing. That means the value of the goodwill will totally be different. So let's first of all determine the goodwill. This one is straightforward. Goodwill will take the purchase consideration. How much is the purchase consideration? Just read the first paragraph. Consideration. Yeah, it should be in foreign currencies, in Kenyan shillings. Are you together? Yeah. How much was it? Yeah, we acquired H on 1st May for 1,200 Rwandese franc. What if you are not given the 1,200? Sometimes you are given, okay, assuming you are not given 1,200, are you together? Where can you find the purchase consideration? Under the non-current? Let's go to the non-current assets. Can you see investment in S? Ilikuwa ngapi? You take 480 Kenyan shillings, but we need it in foreign currency. You translate it. Are you together? When did we acquire them? Yes. Can we go to note number 8? That's why you're given the translation rate. Yeah. On that year, they played 2015. The rate was how much? 2 point. It's Rwandan franc to Kenyan shilling. 2.5. Now, another math student usually make is trying to determine whether to multiply, whether to divide. Yes, kama huku shika FM on how to deal with which is the commodity, direct and indirect quote. Takuletea shida. Now, in that case, note number 8, Rwandese franc to Kenyan, which is the commodity here? Okay, now let me take you back to commodity. Can you try to write it somewhere? This is equals to this. Just smell what you have written. Is 1 Kenyan shillings to 2.5. Anyone else? Hivyo ndivyo wanasema. Yeah, is 2.5 Rwandese franc is equals to 1 Kenyan shillings. Yes. 2.5 Rwanda's franc is equals to 1 Kenyan shillings. What about for 80 Kenyan shillings will be equivalent to how many? Are you together? So you take 480, you multiply by 2.5. What do you get? 1,200. Good. Once you get the net, the purchase consideration, you raise the net asset acquired. Net asset acquired. To the net asset, let's go to the balance sheet. What do we have? Ordinary share capital. Ordinary share capital. How much was it? 320. And also there was retained. But retained earnings you take pre-acquisition. Now let's go to the first paragraph. You already given. How much was it? Yeah, H Limited, a public limited company based in Kenya, owns 75% of ordinary share in S Limited, a public limited company in Rwanda. H acquired S on 1st May 2015 for 1,200 million Rwandese franc, when the retained profit of S Limited was how much? Was 800. So how much? There was nothing else. We had share premium. So let's now also include the share premium. Share premium, an amount of 200. Good. So that is 1320, and then you're controlling them 75%. 75%. 990. Therefore, we had 210. Yes. Goodwill was 210. But this one is Rwandese franc. Are you together? So at the end of each financial year, it will be translated using the rate at that date. So that means, let me show, we get the rate so that we get them in Kenyan. So at the date of acquisition, how much was the goodwill? Now let's be here. Remember, at the date of acquisition, the rate was 2.5. Kwa hivyo is equivalent to how many Kenyan shillings? You divide or you multiply? You divide, right? So you'll get 84. But remember, the goodwill will go to the balance sheet. And we have said that, let me take you back here. To the balance sheet, all asset and liability should be translated using the closing. So that means this was the goodwill as at 1st of May 20. The goodwill is 84. But at the end of the financial year, that is as that year, April 2016, the goodwill is 210, but we will translate using the rate at the closing rate. Let's go to note number 8. That year, April 2016, the rate will be how much? We translate using a rate of 2.1. So 210, you get? That's 100, right? Together. There is a translation gain of how much? Or translation difference of how much? 16, right? Yes, there is something we said, that translation difference should be recorded as a separate equity item. Do you remember that? You don't. It's good to be honest. You say that when you're translating using the closing rate method, the translation differences should be recognized as a separate item under the equity reserve. Now, this is the goodwill will show now to the balance sheet. Are you together? An amount of 100. Now let's continue. Additional information. Number 1, goodwill is reviewed for impairment annually. As at 30th April 2016, the impairment loss recognized on goodwill was 42 Rwandese franc. Impairment was an amount of 42. Let's translate 2.1. Therefore, how much is it? Is it 20? It will be 20. So how much would be the goodwill? Yes. At the end of the year, the goodwill is 100, but the impairment is how much? 20. So the goodwill will show an amount of 8. This is what you take to the balance sheet. Good. Number 2, and this 20 you take it to the income statement. Are you together? As the impairment charge for the year 20. Number 2, during the year ended that year, April 2016, S purchased raw material. Number 2, that's what we call intergroup what? Intergroup purchases. Intergroup sales. If one purchases, that means was sold by someone else. Are you together? So During the year ended 30th April 2016, S purchased raw material from H. Who sold to? H sold to S. Good. Yeah, during the year ended 30th April 2016, S Limited purchased raw material from H and dominated the purchase in Swiss franc in its financial record. The details of the transaction are shown below. Nature of the good, raw material. Date of transaction, 1st February 2016. Selling price was how much? And it's in Kenyan shillings, so we need not to translate. So the intergroup bar sales is 60. Then profit percent on selling price is 20. So we determine the unrealized profit is 20% on selling price. Margin markup, margin, good. You just take 20% of 60. Wacheni kwanza. As at that of April 2016, half of the raw material purchase was still in the inventory. Half. You get 6. 6 is unrealized profit. How do you account for unrealized profit? You add it to cost of sales, you eliminate from the closing stock. Good. Number 3. Number 3. H Limited issued an interest-free loan to S. What is that? The parent give a loan to the subsidiary. Are you together? That means as a parent, how do you record that loan? We did it when you're doing the financial instruments, right? If I give you a loan, to me it's a what? It's an asset. To me, I have given you a loan. Are you together? So to me, it's an asset. Who is the what? Liability. So in the books of the parent, you show it as part of non-current asset. But you as a subsidiary, you show it as part of non-current liability. But within the group, do we consolidate? I'm saying that I'm showing an asset, you're showing a liability. We say that intergroup transaction should be. So in my asset, I'll remove the loan. Also to your liability, you'll remove the. So number 3, H Limited issued an interest-free loan to S Limited of 50 million on 1st May 20. So on 1st, so that's loan. On 1st of May 2015, Kenyan shillings, I give you a loan of how much? 50 million. So how much was the rate at the date? That's the date of acquisition, right? Together. And the rate was 2.5. So how much was in Rwandese franc? If you translate it, it's 50 times that. 125. Are we together? Good. H Limited issued an interest-free loan to S of 50 million on 1st May 2015. The loan was repaid on that 1st May 2016. S Limited included the loan in its non-current liability. So on that 1st of May 2016, he paid the loan. How much do I expect as a parent? Hey, let me repeat again. 50, I give you a loan of 50. So it attracts no interest. So I expect as at that 1st May 2016 to pay back my 50 million. But in this case, we have to translate. Are you together? Because you're operating in Rwandese franc. How much was the rate as at that 1st May 2016? Go to number 8. That was 2.1. So in Rwandese franc, how much will you pay to satisfy the debt of 50 in Rwandese franc? 105. So that means you have to take 105. You translate it so that ifike ikiwa ngapi? 50. Now my question is, there is a difference of how much? 20. Is it again or loss? Remember, you are the one paying, eh? Me, I have no problem. You have to pay me 50. You are the one paying. Did the translation favored you or not? Did not favor him? Favored you. Are you together? Because at the date you borrowed 120, but you only paid 1/5. So that's what you call gain on translation. Are you together? Yes, it will be part of other incomes, but this one is in Rwandese franc. So you convert it to Kenyan shilling because after all, you prepare the group account based on the parent functional currency. So it's 2.1 at the end of the year. So 2.1, okay. What do you take in Kenyan shillings now? It will be 20, the rate is 2.1. You multiply or divide? You divide by 2.1. So in my other income, I record a gain of how much? 9.52. Good. Number 4. The fair value of net asset of S as at the date of acquisition is assumed to be the same as the carrying value. That means there was no revaluation. Number 5. H Limited paid dividend of 80 million during the year ended 30th April 2016. H was the parent, right? Yes, so that only affects the retained earnings only. The dividend had not been included in the company's income statement. Corporate tax rate is 30%. Is the group policy to value its non-controlling interests at acquisition on the proportionate share of the fair value. That means we use what we call the partial goodwill method. I gave you 2 methods. Now it can come. Eh? How do we measure NCI? I gave you 2 methods. One, as the proportionate share of the net asset acquired. Like in this case, we have taken 75% of the net asset. That's what we call proportionate share. Are you together? Or it can also measure at fair value. If we measure at fair value, that means we have to use the full goodwill method. Good. Number 8, the group exchange rate are relevant to the financial statement. So we're given that the rates required. Prepare the following statement in accordance with the application of IFRS. Number A is the consolidated income statement. B, consolidated statement of financial position. You cannot consolidate since we have one financial statement in what? In Rwanda franc. And in this case, the reporting entity is in Kenyan shillings. So that means we have to translate, first of all, the financial statement of the subsidiary to Kenyan shillings. So first of all, let's translate. Translating income statement. How do I translate? So Rwandese franc rate, we get them in Kenyan shillings. Let's go to the income statement. What do we have? We have revenue. How much is the amount? 1420. Then there is cost of sales, an amount of 960. Then we have distribution and admin expense, an amount of 200. What else do we have? Interest payable, the same as interest expense, an amount of 20. Anything else? Yes, income tax expense, an amount of 90. And that's how we get the profit. And they got a profit of 150. How do you translate? We have said that all income statement items are translated using average rate. Let's go to note number 8. The average for the year was rate of 2. We want them in Kenyan shillings. So that means you divide. Eh? Yes. You get 710. You get 480. Eh? You get 100. You get 40. Give me the profit. Is it 75? It's 150 divided by 2. Are you getting 75? Now let's also translate the balance sheet. Translating statement of financial position. Rwandese franc rate, we get in Kenyan shillings. Let's go to the balance sheet. We have PPE. We had an amount of 1420, sorry, 1460. 1460. What else do we have? Current assets. Current asset is an amount of 1020. You're only translating what the subsidiary has. Eh? Yes. Then we go to equity and liabilities. Equity and liabilities. Now for the equity and liabilities, in an exam, we don't have to translate because after all, you know that for ordinary share capital and share scheme, you only take for the subsidiary haina kazi. Are you together? Yes. But let me show how to translate them. Eh? Ordinary share capital, an amount of 320. Share premium, amount of 200. Eh? Then you have retained earnings. Now for retained earnings, allow me to separate them. We have pre-acquisition and we have post-acquisition. Let's go to the first paragraph. How much was the retained earnings? Actually, the date of acquisition was 800. Now let's go to the balance sheet. How much is the retained earnings? 950. Can you be able to get how much is the profit post-acquisition? You just take 950, you raise the pre-acquisition of 800, and they made a profit of? Yes, and this is what we have in our income statement. Are you together? Yes, that's what we have. Then let's go to the non-current liability. Non-current liabilities. Non-current liability, we have an amount of 410, and then current liability, we have an amount of 600. Now the issue is the rate. How do you translate? Friends, do you remember? Closing date for the assets and liability. Now let's go to the closing rate. Not number 8. Closing date was at 30th April 2016. The rate is 2.1. So 2.1, 2.1. Assets and liability. 2.1, 2.1. Then for the equity item, you use? Yeah, use the spot rate. And the spot rate was the date of acquisition. How much was the spot rate? Yeah, we acquired them on 1st. On 30th April 2015 or 1st May. The rate was 2.5, 2.5, 2.5. But we have this 150 for the year. Eh? This one use the actual. So you already translated to 75. Yes, this one just use the actual, which is 75. 150, if you translate, we are getting 70. Now give me that. Let's get them in Kenyan shillings. This one is? Sorry? 695.24. 4.71. 128. 128. 80. 320. 410 divided by 2.1. 195.24. 285.71. So give me the total assets. And someone to work for the total liabilities, total equity and liabilities. Assets 0.95. Liabilities 0.95. You get? Now take 1180.95 minus equity and liability. There is a difference of how much? Sorry? 90? Flat. Now, what do you think is the 97? That's what we call exchange reserve. Are you together? Remember, we are translating. So we have translation gain and translation losses. And that one goes to the exchange reserve. Can take a screenshot of that before we consolidate. So now let's start with the income statement. Yes, don't close your phone. Use it here, mostly for the translated items. Who is the parent? H, so it will be H group, consolidated income statement. For the year ended 30th of April 2016. So our shillings are in millions. We had the revenue. You deduct cost of sales. Here the gross profit. Revenue. How much is it for the parent? Is it 2,000? 2,000. You add for the subsidiary. Now let's be here. In this case, use the translated. How much is it? Yes, 710. Cost of sales, you do the same. 1,200. You add. How much is the cost of sale? 40. 48. Then you add unrealized profit. How much was the unrealized profit? Was it 6? 6. Then you raise intergroup balances. How much was the intergroup balances? Not intergroup balance, but intergroup sales of 60. Good. What do you get? 6 the unrealized profit, 60 is the intergroup sales. 2650. Sorry? It can't be 1194, eh? Yeah, 1194. So give me the gross profit. Sorry. This was 480, not. It was, yeah, it's 480, eh? This should be 480, but that one does not affect the profit. We have worked with that, eh? Yeah. This one should be, therefore this will change. 16? 1626. Yeah, the profit does not change. The profit was 75. Therefore, how much is the gross profit? $10.20. Now let's go to, once you get the gross profit, do you have other incomes? Yes, we have interest receivable. Can you see interest receivable? Yeah, that's the same as interest income. An amount of 40. Then we had an exchange gain. You remember someone who reported an exchange gain? Yeah, exchange gain on what? On loan. How much was it in Kenyan shillings? 9.5, right? Yeah, 9.5. Then you raise the expenses. What do you have to the expenses? You have distribution expenses. For distribution, we had 300, and then you add the distribution for the subsidiary is how much? It's 100. Get 400. Then you also had interest. Can you see interest payable? Yeah, therefore it's interest expense, and that one belongs to the subsidiary. Let's be here. The interest expense, if you translate that, we are getting an amount of 10. What else do we have? Impairment of goodwill. Can you go ahead and have a goodwill? We had a goodwill of 100, then there was an impairment of 20, we get a net of 80. Do you remember that? Yes. How much was the impairment? 20. Good. So give me the profit before tax. 43.5. Then we raise the tax expense. What do we have to the tax expense? 200. Then you add the translated one. How much is the tax expense? 45. So we had a tax of 245. You get 390. 98. 98.5. Then you can show attributable to parent and NCI. NCI is very easy. How much was NCI? 25% of the profit after tax. They made a profit of 70. Yeah, the translated income statement, they had a profit of 75. So you take 25% of 75, which is 20, not 25. 18? 18.75. Therefore, how much do you attribute to the parent? You take 398.5, you rest what you attributed to the subsidiary. 3.75. Good. So now let's present the balance sheet. H group, consolidated statement of financial position as at 30th April 2016. Our shillings are in millions. What do you have to the assets? Non-current assets. We have PPE, right? Yeah, PPE. For the parent was 29. How much was it for the subsidiary? 690. 695. I will get a total of 665. Then you also had goodwill. How much was the value of the goodwill? It's 100 minus 20, and you got 80. Then we had, what else do we have? Just look at the balance sheet. What do we have to the balance sheet? Can you see it on to S? Yeah, that's what you call intergroup what? Transaction. You don't show that, because as a parent, you're showing as an asset, and then as a subsidiary, you're showing as a what? As a liability. So you eliminate it. So we go directly to the current assets. How much was the current assets of the parent? 35, 50. You add, let's go to the translated balance sheet. 480. 771 minus, remember current asset comprises the inventory. Are you together? At the inventory, we had unrealized profit. You raise it from the closing stock. An amount of 6. Yes, current asset, that means it includes the inventory. 4029.71. Good. Give me the total. Total assets 7774.71. Now let's go to the equity and liability. Under equity and liabilities, we have ordinary share capital. We also have the share premium. We also have retained earnings. Also, you'll have to factor in the NCI. CI. What else? Exchange reserve. Are you together? Yes. Exchange reserve. We show that it should be, the exchange difference should be reported as a separate item. Now, there was a question with 6 marks. You explain the treatment of exchange differences. I have repeated it 3 times. But it's what I'm explaining here. Are you together? How am I treating it? So how much was the ownership capital? You want to check for the parent, 600. Share premium, 500. Retained earnings, dash. NCI, dash. Exchange reserve. Yeah, can you go to the translated? There was an exchange reserve of 97 plus, let's go back where we computed the goodwill. We had an exchange difference. Yangapi? 16 plus, let's go to the loan. Loan kulikuwa na kagain kangapi? Difference yangapi? 9.5. Give me that. 122 point? Yes, 122.5. Now let's go to the non-current liabilities. And the non-current liabilities, what do we have? 300. You add. Let's go to the translated. How much was the non-current liability? Was it 195? 195. You deduct. Now, si kuna loan. The loan is included in the liabilities. This loan was from who? From the parent. Are you together? You eliminate them. 50. That's why to the current asset, we never consolidated the loan to S as a current asset. Are you together? You eliminated. Also, you eliminate its gain. Was it included? Now, can you go back to that point? Note number. In note number 3, H Limited issued an interest-free rate to S of 50 million on 1st May 2015. The loan was repaid on that 1st May 2016. S included the loan in its non-current. For hapo sasa, na kama imewekwa, there was a gain of how much? 9.5. Eliminated. You get 430? 0.5. And then we have the current liabilities. What do you have to the current liabilities? We have 2050. You add the translated one. 280.71. You deduct who? There was no intergroup balances, right? So let's add that. 23.71, and then you have to factor in the dividend payable. The parent paid a dividend of 8, but was not recorded in the income statement. Right together? Yes. Can take a screenshot. Stop recording.